Welcome back to The Explainer. Today we're unpacking an absolutely massive structural shift in the corporate landscape. Look, if you've been following the industrial sector, you already know that Q2 of 2026 wasn't just, another routine earnings cycle for Honeywell. It was a total watershed moment. The century-old conglomerate literally hit the reset button to transform itself into a streamlined, pure-play automation giant. We're going to break down exactly how this massive transformation impacted their bottom line, what the new structure actually looks like, and what it signals for the future of the autonomous economy.
Okay, let's dive right into this. When reviewing the official Q2 2026 earnings release, the very first thing you'll probably notice is the new branding, Honeywell Technologies. And hey, this isn't just a fresh coat of paint. It represents their official, finalized separation from their massive aerospace division. By shedding the aerospace wing, they're planting their flag firmly in the ground of automation, really leaning into their massive installed base and deep domain expertise. The earnings release itself is basically the blueprint for their entire new corporate identity.
To make sense of all this, here's our roadmap. First, we'll look at the historic corporate spinoff. Second, we're making sense of the numbers. Third, we'll cover the 3 pillars of automation. Fourth, the aerospace departure. And finally, we'll wrap up with the upgraded outlook for 2026.
Starting with Section 1, a historic corporate spinoff. It really is a completely new era for Honeywell Technologies.
I think CEO Vimal Kapur really hit the nail on the head here. He stated, "The second quarter marked a historic milestone for Honeywell Technologies as we completed the separation of Honeywell Aerospace and began a new era as a leading pure-play automation company." That specific term, pure play, that is the strategic key to this whole thing. This quarter was the culmination of a year-plus-long process to dramatically simplify their business model. They're completely shifting away from being this sprawling, massive conglomerate to focus exclusively on driving the industrial sector's transition from automation straight into autonomy.
And this brilliantly illustrates just how fast this structural shift occurred over the summer of 2026. I mean, think about it. Right before June 29th, Honeywell was still operating as its legacy consolidated self. Then, boom, on June 29th, they successfully complete the spinoff. Fast forward less than a month later to July 23rd, and they release these Q2 earnings as the newly minted Honeywell Technologies. Meanwhile, the now independent aerospace division, which trades under the ticker HON by the way, was slated to release its own standalone earnings shortly after on August 5th. It was just a highly orchestrated, incredibly rapid corporate uncoupling.
Moving on to Section 2, making sense of the numbers. We really need to separate the signal from the noise here.
Because this spinoff happened right at the tail end of the quarter on June 29th, the Q2 earnings report naturally features 2 completely distinct sets of data. So let's act as a translator for a second. First, we have the consolidated results, basically the old Honeywell. They posted $9.7 billion in sales and a massive $38 billion backlog. But to understand where the company is actually heading, we have to strip away aerospace and focus purely on the standalone automation metrics. The new Honeywell Technologies standalone business generated $5.2 billion in sales with a $20 billion backlog. Now, obviously, those standalone numbers are smaller, but the underlying health, it's incredibly strong. The standalone business actually saw a 16% jump in orders, which pretty clearly proves that this pure-play automation model has immense momentum right out of the gate.
Now, if you happen to just glance at the headline, earnings per share, you might have done a complete double take at this number, $16.65. For the standalone business, that represents a staggering 1,276% jump from the prior year. No way, right? Well, as a focus learner, you know there's usually more to the story. That massive spike is actually heavily tied to a one-time gain on the deconsolidation of a subsidiary called Quantinuum. If you strip away that one-time accounting gain, the adjusted EPS was $1.95, which, by the way, is still a very solid 10% increase year over year. So always remember to check those adjusted figures to see the true operational baseline.
All right, Section 3, the 3 pillars of automation. We're talking building, process, and industrial.
So now that we've isolated that new $5.2 billion standalone business, we can really break down the real-world drivers. Now, what's really interesting about this is the clear variance in organic sales growth across these 3 pillars. Building automation was absolutely the star of the quarter, surging by 9%. Industrial automation posted a very respectable 4% growth. Meanwhile, process automation saw a slight contraction, dropping about 1%. Let's dig into the mini-narratives driving each of these different segments.
So why exactly did building automation perform so incredibly well? It really comes down to some very tangible real-world megatrends. They saw a 13% increase in orders, heavily fueled by robust growth in the data center vertical, which, makes total sense given the absolute global boom in AI and cloud infrastructure right now.
They also saw really strong demand in hospitality, and their fire business experienced double-digit growth. This isn't just abstract numbers on a page. This is Honeywell providing the critical intelligence and safety systems for the buildings of tomorrow.
The story for the other two pillars is a little bit more mixed, but honestly, equally fascinating. In process automation, despite that 1% sales dip we just talked about, their orders actually rocketed up 24%. This was largely driven by massive global demand for liquefied natural gas, or LNG, but their margins took a bit of a hit because of lower catalyst shipments compared to last year. Then, over in industrial automation, they achieved 4% overall growth, but the solutions side specifically jumped 10% thanks to some really strong utility projects and converting their backlog in the warehouse business.
Let's transition to Section 4, the aerospace departure, a final look at the legacy giant. Before we look entirely to the future, it's pretty important to briefly understand exactly what Honeywell left behind. It really helps you appreciate the sheer scale of the structural transformation. In its final quarter under the corporate umbrella, the aerospace technology segment generated a massive $4.5 billion in sales, with 5% organic growth. Think about that. That is nearly half of the legacy conglomerate's total revenue. Carving out a $4.5 billion business, that is an operational feat that honestly cannot be overstated. It just underscores how fully committed leadership is to this pure-play automation strategy.
And breaking down where that $4.5 billion actually came from shows a division that was generally thriving, but facing some very real-world constraints. Commercial aviation original equipment surged 17% as global flight build schedules finally began recovering. The commercial aftermarket grew 7%, totally driven by demand from existing fleets. However, defense and space remained completely flat. Not because of a lack of demand, mind you, but because mechanical supply chains and output timing severely constrained their ability to actually deliver the products.
Which brings us to Section 5, the upgraded outlook for 2026. This really shows their confidence in the simplified structure. Let's move to see how this builds into their future projections. This is where we see leadership's absolute confidence in the newly simplified corporate structure. Their guidance numbers tell a really fascinating story. When analyzing the top-line expectations, they actually tightened their overall sales slightly, from a high of $20.2 billion down to a flat $20.0 billion. But look at the other metrics. They actually raised their expectations for organic growth from a max of 3% up to 4%, and they bumped up their adjusted earnings per share. This perfectly illustrates the entire goal of the spin-off. You might have slightly smaller total sales on paper, sure, but the core business is growing faster and generating way more profit per share.
And that increased profitability is beautifully highlighted by this specific metric: 250 to 290 basis points. That is the expected segment margin expansion for the full year. Expanding margins by nearly 300 basis points is incredibly difficult in the industrial sector for sure. But it clearly signals that the leaner, meaner Honeywell Technologies is operating with exceptional efficiency and serious pricing power.
So the crucial point is this. Despite undergoing one of the absolute largest structural upheavals in the company's entire history, their cash flow expectations remain incredibly stable. They're projecting $2.1 billion in operating cash flow and holding completely steady at $2.0 billion in free cash flow. This proves that the underlying machinery of the business basically hasn't skipped a beat during this massive transition.
We've seen the historic timeline, we've untangled the complex, dual-reporting financials, and we've analyzed the really robust growth in building and industrial automation. Honeywell has successfully shed its legacy conglomerate status to focus entirely on the future, which leaves us with one final, pretty provocative question to chew on. Will Honeywell's pure-play automation gamble make it the definitive leader of the autonomous future? The Q2 numbers definitely suggest they are off to an incredibly strong start. But, while only time will tell how this new era actually unfolds. Thank you so much for joining me for this explainer, and as always, keep learning.